with a very sour view.
Okay, Brian Chung, Ali Vitale, Peter Baker, we'll have to leave it there. Jake Ward, you're going to stick with us. I want to bring in right now Douglas Holtz-Eakin, former chief economist of the President's Council of Economic Advisors, former director of the Congressional Budget Office, and now president of the American Action Forum. Douglas, thanks for being with us here. We touched on this with Peter, but you also say this is nothing like what we saw post-2008 financial crisis. How so? And are there any warning signs you're looking for that could change your mind?
Well, if you think back to the 2008 crisis, the hallmarks were investments that were sometimes not on the bank's balance sheet. When they were in these derivatives and highly leveraged, complicated assets that no one could understand their value, and they all turned out to have some mortgage risk in them. So there was a lack of transparency. There was a big part of the difficulty in diagnosing who was in trouble and who wasn't. That's not at all what happened at Silicon Valley Bank. What happened there was they clearly mismanaged their capital, and their depositors, sophisticated, hedge funds and venture capital funds, saw it, and they took their money out. They took $42 billion out on a Thursday. For comparison, the previous largest bank run was $16 billion and took 10 days. This was money flowing out at over $1 million a second because they knew the bank was in trouble. And that transparency was, in the end, what they could not escape. So it's very different than 2008. You have big management errors. There's an open question, which the Fed is now trying to address by appointing William Barr to investigate the oversight. Bank examiners should have seen this mismatch. This is a sort of Econ 101 mistake, and it shouldn't have happened. So both on the supervision side and on the management side, the Silicon Valley Bank is just a real management error.
I want to talk on the supervision aspect in a moment, but first, Doug, we talked about this with Jake, that shares of U.S. regional banks nosedived yesterday. We saw San Francisco-based First Republic struggle. They've been able to meet withdrawal demands thanks to help from J.P. Morgan Chase. How worried are you that more mid-sized regional banks will follow? And again, is this just a simple case of panic leading to panic, and how do you stop that?
The market usually does this, the guilt by association. If you look at the size of Silicon Valley Bank and have the same kind of business model, that they're going to penalize you. But the key here, I think, is that we went about 15 years with zero interest rates, and Silicon Valley Bank was unable to manage a clearly anticipated rise in interest rates. They just didn't do it. If other banks see that the Fed's going to raise, and the Fed will continue to raise, they're going to adjust their capital to accommodate that, and there won't be a problem. I think today, so far, that's what we're seeing. The Fed has taken the extra step of setting up a loan fund for banks that find themselves in the position of Silicon Valley Bank. That, I think, is one of the things to really keep an eye on, because Peter Baker's right about the potency of the bailout word. If another bank looks like Silicon Valley Bank, they can go to this fund, give them their treasuries, and get back at face value a loan. That's just injecting cash into that bank, and the B word might come up. So I think it's worth keeping an eye on that part of this response.
Doug, when it comes to supervision and regulation, we know that some lawmakers have really come out and attacked a 2018 law that rolled back some of these banking regulations. We saw an op-ed in the New York Times by Senator Warren. She said they would have, if this hadn't been passed, subject to stronger requirements, it would have had to expose their vulnerabilities. Do you agree here that tougher restrictions should be put in place?
I don't think that's the lesson of Silicon Valley Bank. The lesson is that under either set of rules, pre-2018, post-2018, the bank examiners should have seen this. This isn't about the framework for regulation. It's about the execution. You can't have a bank exclusively holding an asset that's going to diminish in value really rapidly as interest rates go up. That's just the wrong thing to be doing in this environment, and somehow that was not detected either by the CEO or by the supervision. And it really doesn't have anything to do with the rules. I don't understand how it happened.
Okay, Douglas Holtz-Eakin, thanks so much for coming on. Appreciate your time.
Thank you.
We're following more breaking news. Meta CEO Mark Zuckerberg says in a new blog post the company will lay off 10,000 employees.